Bitcoin has spent months frustrating investors. Every rally gets sold. Every headline says the same thing. The cycle is over. The easy money is gone. Institutions are leaving. Millions of investors have quietly stopped paying attention, but behind the scenes, something completely different is happening. One institutional portfolio manager who has consistently beaten Bitcoin itself says the odds are Bitcoin will be materially higher 1 year from today. Not because of hype, not because of memes, not because retail investors suddenly return, but because 5 powerful forces are quietly aligning beneath the surface, and almost nobody is talking about them. Today, we're going to break down exactly what Wall Street is seeing. Stay with me until the end of this video, because what I'm about to show you changes how you'll look at every red candle on your screen from this point forward. Before we go further, quick disclaimer. This video breaks down publicly available market data, institutional commentary, and historical patterns. It is not financial advice, and nothing here should be treated as a personal recommendation to buy or sell anything. Always do your own research. Now let's get into it. If this is your first time here, this is the wealth continuum, where we break down what smart money is actually doing, not what the headlines say they're doing. If that sounds like something you need, hit subscribe, because what's coming in the next 20 minutes is going to change how you read every Bitcoin headline from here on out. One quick thing before we dive in. Morning, afternoon, or night for you right now, drop it in the comments. I want to see where in the world this video is landing. Let's start with what everyone already knows, because you need to understand exactly how bad this looks on the surface. Bitcoin closed out June down roughly 20% for the month. It fell to its lowest level in over 21 months. For the first time in 4 years, Bitcoin closed a full week below its 200-week moving average, a line that has acted like a floor through multiple cycles. Bitcoin exchange-traded funds just posted their worst monthly outflow since they launched. Over $4.5 billion left those funds in June alone, led by BlackRock's flagship fund. That's not a small retreat. That's the biggest one-month exit institutional money has ever made from Bitcoin ETFs. Retail sentiment has followed the price down. Search interest is fading. Comment sections are quiet. The people who were calling Bitcoin digital gold 18 months ago have gone silent. And on top of all that, one major bank just cut its 12-month Bitcoin price target sharply, citing ETF outflows, weak investor interest, and slow progress on crypto regulation in Washington. So if you're only looking at price, this looks like a market in retreat. It looks tired. It looks over. But here's the thing. This is exactly when institutions start asking a different question, not how low can this go, but who's actually still selling and who's already stopped. What if falling prices aren't actually the real story here? What if the real story is happening somewhere else entirely, somewhere most investors never think to look? Think about how this cycle has unfolded so far. Bitcoin opened the year above $93,000, riding a wave of optimism about ETF adoption and corporate treasury buying. Then macro pressure hit, rate expectations shifted, liquidity tightened, and the same asset that felt unstoppable in January suddenly felt fragile by June. That whiplash is exactly why most retail investors get shaken out at the worst possible moment. They bought the excitement near the top, and now they're selling the fear near a potential bottom. It's the same pattern that's repeated in nearly every major cycle Bitcoin has ever been through. Stick around, because that question is about to get a lot more interesting. Here's the part nobody's paying attention to. Professional investors don't stare at the price chart the way retail traders do. Price is the last thing that moves. Before price moves, seller behavior moves. Think of it like a marathon. In the brutal middle miles, the fastest runners don't necessarily speed up. What actually happens is that everyone else simply runs out of gas. The pace slows not because anyone's pushing harder, but because exhaustion sets in everywhere except at the front. Markets often reverse the exact same way. The selling doesn't stop because buyers suddenly flood in. It stops because sellers run out of reasons, and run out of coins, to sell. And right now, there are real signs of exactly that kind of exhaustion. Data from on-chain analytics firms shows Bitcoin whales, the large long-term holders, have accumulated more than 270,000 coins in just the past 2 weeks. That's not retail panic buying the dip. That's patient, large-scale accumulation happening at exactly the moment headlines are calling this dead. More than half of all circulating Bitcoin is currently held by people sitting on an unrealized loss relative to what they paid. Historically, that kind of washout has shown up close to major cycle lows, not cycle tops. One institutional manager, someone who has built a career studying exactly this kind of positioning, pointed to something most investors never watch at all. Not the price candle, but the behavior of the people who've held the longest. When long-term holders stop selling into weakness, that's often the first quiet signal that a shift is coming, long before the price confirms it. This is where smart money is already moving, not loudly, not with headlines, just quietly building positions while everyone else is looking the other way. There's another layer to this that most people scroll right past. Derivatives markets, the futures and leveraged positions that amplify short-term price swings, have been quietly de-risking. Open interest, which measures how much leveraged money is sitting in the market, has dropped sharply from levels above $90 billion down to roughly $45 billion over recent weeks. That's traders closing out risky, leveraged bets rather than piling into new ones. At the same time, exchange balances tell a similar story. More coins are leaving exchanges than arriving, which typically signals holders moving Bitcoin into long-term storage rather than preparing to sell. None of this shows up in a simple price chart. You have to actually go looking for it. Are you positioned right now, or are you just watching from the sidelines? Comment below and let me know honestly, because what comes next explains exactly why timing matters more than you think. Here's a question worth sitting with for a second. Why would anyone care more about what happens months from now than what happens tomorrow? Bitcoin has a well-documented seasonal pattern tied to its 4-year halving cycle. Historically, the months following a brutal first-half correction have set up some of the strongest recoveries in Bitcoin's history. Going back over a decade, the month right after a weak second quarter has closed positive far more often than not, and when it's positive, the average gain has been substantial. But that's not really the interesting part. The interesting part is why institutions position before confirmation instead of waiting for proof. Here's the truth. Most retail investors never internalize. Institutions don't get rich buying certainty. They get rich buying probability. By the time a trend is confirmed, by the time the headlines flip from fear to excitement, the best part of the move is usually already gone. Professional money isn't waiting for certainty. It's positioning for a range of outcomes, weighted toward the ones history suggests are most likely. There's also a very specific, very real catalyst sitting on the calendar. The Federal Reserve meets again at the end of this month. That single decision, whether policy stays tight or starts to loosen, is one of the two forces institutional desks say will determine which way this market breaks. The other is whether ETF outflows finally reverse into inflows. Neither of those things has happened yet, but both of them are being watched closely by exactly the kind of money that doesn't wait for the front page to catch up. There's also a longer-term pattern some chart analysts have pointed to, tied to Bitcoin's roughly 4-year rhythm of accumulation, expansion, and correction. In past cycles, the deepest points of pessimism, the moments when sentiment felt most broken, often lined up with periods that, in hindsight, marked the early stages of the next major move. That doesn't mean this time repeats exactly. Cycle patterns don't always play out the same way twice. And anyone telling you they know the exact bottom is selling certainty they don't actually have. But it does mean that the current mood, quiet, exhausted, dismissive, is historically the kind of mood that's shown up before major turns, not after them. This is exactly why this matters right now, and not 6 months from now when everyone else finally notices. Now let's zoom all the way out, because this is the part of the story most people miss entirely. Retail investors watch the Bitcoin candle. Wall Street watches the infrastructure being built underneath it. Sovereign nations have been quietly discussing and, in some cases, building strategic Bitcoin reserves. Corporate treasuries, companies that have nothing to do with crypto as their core business, have added Bitcoin to their balance sheets as a hedge against currency debasement. Regulatory frameworks for stablecoins and digital assets have been moving through legislatures, slowly but steadily, creating the plumbing for larger institutional participation down the road. Spot Bitcoin ETFs, even with June's painful outflows, still hold roughly $80 billion in assets between them. That's an entire industry that didn't exist a few years ago, now fully built, fully regulated, and sitting there waiting for sentiment to turn. This is the part that changes how you see everything else in this video. Wall Street isn't buying candles on a chart. They're buying infrastructure that gets more valuable the longer it exists, regardless of what price does this week or next week. What happens next is the real story. It's not about whether Wednesday's close was green or red. It's about whether the scaffolding being built right now turns into the foundation for the next major leg of adoption. Consider the players quietly involved in this story. Publicly traded companies with no connection to crypto as a core business have added Bitcoin to their treasuries, treating it the way a previous generation of corporate finance departments treated gold or foreign currency reserves, as a hedge against a currency losing purchasing power over time. Asset managers who spent years dismissing Bitcoin as a fringe asset now run dedicated products tracking it. Custody providers, the companies that securely hold digital assets on behalf of institutions, have built entire businesses around solving the security and compliance problems that used to keep large pools of capital on the sidelines. None of this happened overnight, and none of it depends on this week's price action. It's been built slowly, deliberately over years, the kind of infrastructure that doesn't get torn down just because a monthly chart turned red. Hit, like right now if this is starting to click for you, because the next part is where this gets genuinely strange. Here's a question you probably didn't expect in a Bitcoin video. What does artificial intelligence have to do with Bitcoin? More than you'd think. Bitcoin mining companies run massive fleets of specialized computing hardware, and they need enormous, reliable, cheap electricity to run it. At the exact same time, the artificial intelligence boom has created explosive demand for data center capacity, GPU power, and electricity, often in the same regions, sometimes from the exact same power grids. Several publicly traded Bitcoin mining companies have started converting parts of their operations toward AI and high-performance computing hosting, essentially renting out their power infrastructure to AI companies that are desperate for capacity. That's turned mining businesses that used to be purely a bet on Bitcoin's price into businesses with a second, entirely separate growth engine tied to the AI build-out. This means some of the smartest infrastructure money isn't choosing between Bitcoin and artificial intelligence anymore. It's finding the businesses sitting at the intersection of both. This is where things start to break down for anyone still thinking about this market in simple, single-asset terms. The lines between Bitcoin trade and AI trade are blurring in real time, and almost nobody outside of specialized funds is talking about it. Here's why that matters more than it sounds like it should. Electricity access, land, and power infrastructure are finite resources. There's only so much cheap, reliable power available in any given region. Mining companies that already secured long-term power contracts years ago, back when nobody was fighting over electricity, are now sitting on an asset that both the Bitcoin network and the artificial intelligence industry desperately want. That's not a coincidence. That's a structural advantage that took years to build and can't easily be replicated overnight by a new competitor showing up today. So while retail attention stays fixed on the price of one coin, a much quieter trade has been building around who actually controls the power those systems need to run. Here's another surprise that separates how institutions think from how retail investors think. A lot of professional money doesn't actually want to hold the coin directly. It wants exposure through businesses, miners, infrastructure providers, and companies with real cash flow tied to Bitcoin's ecosystem. Why? Because a well-run mining or infrastructure company can generate revenue, manage costs, hedge exposure, and grow its balance sheet in ways a single unit of Bitcoin simply cannot. A coin just sits there. A business can compound. That's part of why some of the more sophisticated positioning happening right now isn't just buy Bitcoin. It's buy the picks and shovels businesses sitting underneath the entire ecosystem, the miners, the custody providers, the exchange infrastructure, and now increasingly the AI-adjacent power plays we just talked about. This is a more advanced way of thinking about this market than most crypto content ever covers, and it's exactly why institutional portfolios often look completely different from retail portfolios, even when they're both bullish on the same underlying thesis. There's a psychological reason for this too. Owning a business gives an investor something a raw commodity never can. A management team making decisions, a balance sheet that can be analyzed, an evaluation framework that fits inside decades of traditional investing experience. A pension fund or endowment that would never get approval to hold a volatile digital asset directly can often get approval to hold shares of a publicly traded, regulated company that happens to have exposure to that same asset. That single distinction has quietly opened the door for enormous pools of capital that were previously locked out of this space entirely. This is a big part of why the underlying, less visible parts of this ecosystem, the businesses, the infrastructure, the picks and shovels plays, often move well before the asset itself gets the credit for it in the headlines. Now, it's important to be honest here, because no serious investment thesis is complete without an expiration date. This is not a guarantee. Nothing in markets ever is. There are real risks sitting on the table right now. If the Federal Reserve surprises the market with a hawkish tone at the end of this month, risk assets across the board, Bitcoin included, could come under further pressure. If crypto legislation in Washington stalls further, that removes one of the catalysts institutions have been waiting on. If Bitcoin loses key support levels on heavy volume, some analysts have pointed to the possibility of a slide back into the low $50,000 range, or even lower. There's also the mining and AI story cutting both ways. If AI infrastructure demand cools off, or if power costs spike, some of those diversified mining businesses could see that second growth engine stall out. And broader market liquidity conditions, how easily capital moves through the financial system, remain a genuine wildcard heading into the back half of the year. Professionals build in these scenarios because every investment thesis deserves an expiration date. That's exactly why institutions constantly reassess their assumptions instead of falling in love with a single narrative. It's part of what separates disciplined positioning from blind faith. Beyond that, there's the simple, uncomfortable reality that Bitcoin remains one of the most volatile major assets in the world. Corrections of 30, 40, even 50% have happened multiple times across its history, and there is no rule that says this cycle is exempt from that pattern. Anyone approaching this market without accounting for that kind of drawdown risk is not thinking like an institution. They're gambling and calling it conviction. Regulatory risk cuts both ways as well. Favorable legislation could unlock the next wave of institutional capital. But delays, unexpected enforcement actions, or a change in political leadership's approach to digital assets could just as easily stall momentum for months. This is not a market where the rules are fully settled, and anyone telling you otherwise is skipping over a very real piece of the puzzle. Do you think the system can hold through all of this? Now, that's a real question, and I'd genuinely like to know what you think. Drop it in the comments. So, after everything we've walked through, let's come back to where we started. Falling ETF flows, a broken moving average, a bank cutting its price target, retail sentiment gone quiet. On paper, every single headline says this market is done. And yet one closely followed portfolio manager who tracks this market as closely as almost anyone on Wall Street still comes back to the same conclusion. Despite all of that uncertainty, the odds still favor Bitcoin being materially higher a year from now. Not because tomorrow looks perfect. It doesn't. Not because next week is guaranteed to be green. It isn't. But because the underlying forces, quiet long-term holder accumulation, historically favorable seasonal patterns, expanding institutional infrastructure, the collision between Bitcoin mining and the AI power build-out, and the slow, steady maturation of regulatory frameworks all continue to point in the same long-term direction, even while short-term price action looks ugly. Markets don't reward the people who react first to a headline. They reward the people who understand the structure underneath the headline first. Think back to every major turning point in Bitcoin's history. Each one looked broken right before it wasn't. Each one had its own wall of skeptics, its own pile of bearish headlines, its own wave of investors who gave up right before things turned. That doesn't guarantee this time repeats the same way. But it does mean betting against every long-term signal simply because the last 30 days looked ugly has, historically, been one of the more expensive mistakes an investor can make in this asset class. By the time the headlines turn optimistic again, the easiest part of the opportunity is usually already gone. So the real question isn't whether Bitcoin makes a new high tomorrow or even next month. The real question is whether the biggest players in this market are quietly positioning right now for a future most investors still can't see. And if history is any guide, by the time everyone finally agrees on what's happening, the market will have already moved. What would you actually do if this plays out the way it has in past cycles? Would you be ready, or would you be watching from the sidelines again, wishing you'd paid attention sooner? If this video helped you see this market differently, hit like, drop a comment with your honest take, and subscribe if you want to stay ahead of what's coming instead of reacting to it after the fact. And if you know someone who's convinced this market is finished, share this with them. Sometimes the most valuable thing you can give someone isn't a prediction. It's a reason to look again before it's too late. I'll see you in the next one.